Hey, welcome back to the Ridge Podcast. We are super excited you're here. I'm Meg.
I'm Fred.
And we're talking about crowdfunding today. So we just had an episode, Fred, about what is crowdfunding, touched on the basics. Can you give us a quick summary of what is crowdfunding?
Crowdfunding is an exemption from registration. When a company wants to sell equity, by law they have to register with the Securities and Exchange Commission. And Congress passed a law called, well, it's not called crowdfunding, but it is named in the law crowdfunding, that allows an issuer to sell an equity or a security without registration.
Good job.
As long as they follow certain laws.
As long as they follow certain laws.
No, I'm not going to keep it.
Actually, as long as.
PS, PPS.
Exactly.
PS.
Addendum, note to instruction to paragraph 7.
That's right. Yeah.
So when we're talking about crowdfunding, you can kind of separate it into 4 different types of crowdfunding.
Right.
The way that I think about it is there's donation-based,
Okay.
which can I name like some platforms?
Sure.
Is that okay? Which would be like your GoFundMes, right? You give money toward a cause or a project without expectation of anything in return.
Yeah.
There's reward-based crowdfunding. Do you want to take that one?
Sure. You mentioned Indiegogo.
Yep.
And I guess Kickstarter is the one in my mind where you're buying a thing beforehand, typically.
Like a pre-sale.
Yeah.
Another type is equity-based crowdfunding.
Yep. That's now equity is ownership in a company, and so it is a company who is selling ownership in their company to investors.
All right, and finally we have debt-based crowdfunding,
Yeah.
which is a loan.
Yep.
It is also a security like equity, but essentially the investors get their money back plus a return, but no ownership in the company.
Yeah. The return can be an interest rate or a fixed amount, something like that.
Okay. What we do here at Ridge, equity and debt-based crowdfunding. We don't have anything that's donation-based or rewards-based, although there may be perks involved. Would you walk us through why a company might choose equity versus debt?
Sure. Yeah, I mean, both are a security, and that's why we deal with both of them. But a company, when they're trying to analyze what they want to sell, is going to do so based on, I'm going to say, the pros and cons of each format of sale. Like you mentioned earlier, debt does not give you the buyer ownership in the company. So if they don't want to dilute their ownership, they can do that. And I imagine that a company who is a little bit more sure about their financial return on that investment is more likely to turn to a debt. And what I mean by that is they don't want to give away equity. That's typically the last thing a company wants to give away is equity in their company. And if they also know very surely or more surely or more, sorry.
Yeah, don't call me Shirley.
That's right. I'm just imagining airplane in my head. Then why would they give away the equity? And so they can know the cost of their capital and do it as a debt. And that's why I think a lot of times real estate investors obtain debt investments because they already have a plan of how they're going to purchase a building and remodel it and increase the tenants or the rents, and then it's going to be worth so much, and then they're going to refinance, and then when they refinance, they've got the money out, and they know that time period, and they have a very good, if they're experienced, they have a very good estimate of how much money they'll have available to repay, and but then they don't have to get rid of the ownership.
Right.
And so they have a higher upside that way. But if there's a high risk, they don't know if it's going to work or not. And this isn't always true. I shouldn't say that this is always true because we have public markets, stocks, the stock market. Why would they do that if it was too high risk?
Sure.
It's not always the case. But in some analysis, when you're trying to pick between them, if you want to have the money without an obligation to pay it back, then you sell equity. And that doesn't necessarily mean that it's a bad thing for the investor, like, they never want to pay it back. Like, that sounds wrong, right?
Yeah.
Well, sure, but except when something is publicly traded, for example, there is a market, there's an exit available in the stock market. Now, with private offerings, that's not so much the case. There are platforms that are trying to build trading systems where previously private offering sales can be traded. So anyway, the same logic doesn't always flow across public and private offerings, but
Sure.
for many private offerings, they're higher risk and so potentially higher reward, and the issuer likely is not certain about what the return is going to look like.
Sure. One of the things that came to me as you were talking is the idea of the secondary markets, and I could see an investor who maybe doesn't know so much about the history of crowdfunding wondering, how is it that you could do this and not have a secondary market? So can you speak to sort of when crowdfunding was
made legal?
Yes.
Yeah. And I agree with you. There are people who have come to the platform who have not understood that with their investment, even though it's outlined in the documents. They don't understand that there isn't a liquidity with that investment. So they come and say, hey, I'd like to sell my shares. I'm like, okay. The issuer allows you to sell your shares if you find a buyer.
Yeah.
And anyway, so there's a risk with the liquidity.
Can you define liquidity, illiquidity as it pertains to investments?
Yeah, just the ability to sell it for cash, turn it into money.
So public stock market investments.
Very liquid.
Very liquid, because you can just sell it
Go
off.
to the stock market. Now, there's obviously limitations, like you can't really sell it after hours or on the weekend when the stock market is closed. Otherwise,
pretty liquid.
It's very liquid.
Whereas private investments,
very illiquid.
Yeah.
Like you have to find a buyer, you have to negotiate a price, a deal. Often in the operating agreement or the purchase agreement of that security, there's a requirement that the seller, the person who is an owner, if they want to sell, they have to, and they find a buyer and they make a deal, they have to give that deal to the company and say, by the way, do you want to buy this deal instead of this person? And so it's a very long process of determining all that stuff.
So very illiquid, very
Right. Costly too.
much more difficult to turn from your investment to cash.
Correct.
Okay. The other question was essentially, can you explain how old regulation crowdfunding is, and
Now I remember.
why there might not yet be a secondary market?
Yeah, so it was, I believe, 2011 or 2012. I'm leaning towards 2011. The law was passed. It was the Jobs Act at the time, and Congress instructed the SEC to make rules and regulations to allow crowdfunding. And they kind of gave a structure of what they wanted to have happen, and then the SEC had to go implement it. And so I think it was 2014 or 2015 when the SEC finalized those rules and regulations and crowdfunding began. So it's a very young market still. There are some secondary trading platforms, just not a lot, and nobody knows about them anyway.
So that's kind of where I'm heading, because it's so young, people are still developing what are best practices for this, although, obviously we follow the rules. But still developing secondary markets, that kind of thing.
Yep.
Time horizons for equity versus debt. It seems to me like debt's shorter. Is that
It's
true?
not always true.
Okay.
It is up in the air. It could be a 3 to 5 year return period.
For a debt? Oh my
It can be. But that's also true of an equity. It could be 5 or more. The company needs enough time to spend that money, grow their business, reinvest revenues, and keep doing that over and over and over again until they have enough money to make payouts. And for startups, that often is never. What they're really doing is they're waiting to get bought by a larger company or have some other exit where then they can pay out all those investors and hopefully the values increase significantly. And so, very illiquid. But so often with the deals that come on the film side for debt, it's the deal terms are that it's last money in and first money out of the deal for films going into the theater.
Mm.
And so it's very short for that reason, because that they're coming to us right at the last moment.
Yeah.
Whereas if it was a debt deal for real estate, it could very easily be, 3 years.
Gotcha.
Where they're at the beginning stages of development, they are then negotiating buying a property and then doing the groundwork and then starting to build. Anyway, it can take a while.
Okay. Something you touched on, but I just want to summarize. What can investors expect as far as like pay structure from deals on Ridge or similar deals? Is it regular payments? Is it one-time payments?
Yeah, often with real estate deals, you're buying an equity piece in the company, and it will have regular payouts. That is, if the building is already completed and what you are buying is, that completed project, and the management company who you're partnering with basically in the investment, their goal is likely to renovate, to increase rents, maybe to expand if there's more ground that they can build on, or add other amenities and then increase the rents, and then later they might do some kind of exit or refinancing, but in the meantime they're earning money through the rent, and they will often do quarterly or annual distributions on those.
For investors who are new to equity in a company, how does the decision get made to do a payout or disperse dividends or something like that?
Yeah, the company has to say it would be, if they're doing an analysis, what they are likely saying is, we have all this money, what is the best use of it? When you were asking a question previously about, or we were discussing the idea previously about what does someone want to analyze when they're looking at a company, it is the executive team. Do they know what they're doing? So will they know to ask the question, what's the best use of our money, and will they come up with the right answer?
Okay. What I want to summarize or drive home here for investors who are new to this is that investors don't get to decide when a dividend happens.
Yeah.
I think some of our investors are like, hey, can I have one of those?
Exactly. They're like, I really need that money back.
Yeah. And it's up to the owner. And so, as you're saying,
and it won't be on a one-to-one basis.
Right. So it's really important that as you're analyzing the deal, by investing, you're sort of expressing, to a certain extent, trust in this executive team. I trust that you can make the right decision for the company, whether that's payouts or reinvesting in the company.
Yep, exactly.